Good evening and welcome to the Wealth Empire Weekly Market video. Tonight we are going to continue what we began last week in a study we are calling Testing the Warren Buffett Method. And tonight we'll begin with part 2. Now last week we introduced part 1 of the study, Testing Warren Buffett's investment method over a full market cycle. We outlined our research and showed the benefits of owning companies with predictable and proven earnings. Today we continue with part 2. What we're going to do is be ranking that predictability, so essentially taking it a step further to ensure that our results were not a fluke. We already demonstrated a strong correlation between the predictability of a company's earnings and its stock performance over a 10-year period. But let's take things a step further. By using an algorithm that measures annual revenues and earnings for the previous 10 years, stocks were assigned 1 to 5 star predictability rankings. This allows us to dissect our 570 predictable companies, again for the entire 98 to 08 period, even further and determine if the correlation between predictability and stock performance exists on a more precise level. The following charts demonstrate the difference in predictability rankings. This is Walgreens, a 5-star predictability company, which demonstrated precision growth and was virtually glued to the 15% growth trend line. So whether or not you can see it here, there are actually two lines on this chart. The orange one here being the revenue per share charted on annual numbers, and there's actually a faint green line behind this showing a perfect 15% trend line. Now this is an example of an extremely predictable, smooth company. Analog Devices, on the other hand, is only a 3-star predictable company. Now, it was still profitable, remained profitable each and every year, but at a less consistent level. Here we see the revenue per share in orange once again, but notice it kind of flips back and forth along that growth trend line, so it was nowhere near as consistent as Walgreens in our previous example. So after ranking all of our 2,403 stocks from 1 star, meaning not predictable, to 5-star, very predictable, we're able to further dissect our list of securities and examine the predictability correlation even closer. Let's look at the findings. Now here we can immediately see that the higher predictability companies, starting to the far left with a 5-star ranking, all the way to the right to a 1-star or non-predictable ranking, have far better performance as we increase that predictability factor. So we can see here the percentage of stocks in that group, the percentage that lost money. Notice the less predictable are more and more likely to lose money. The average gain almost seamlessly steps down as we go through the lower predictability levels. The median gain does the same thing. When we look at the maximum gainer, these numbers are a little bit all over the place, but again, that's just one particular stock. The maximum loser, pretty much the same thing. The two numbers I like to focus on are the annualized average gain and the annualized median gain. This is going to show us what on average the stocks in these groups were doing. And once again, we're seeing the performance from 4 and 5-star predictability, the most predictable companies out there, far exceeding the performance from the 1 and 2-star companies, and everything in between kind of meets that same criteria. So we've got really clear evidence here to support the stock price performance being far in excess in these higher predictability companies than it is on the other end of that spectrum. So the data from our groups of ranked securities confirms our thesis, right, of a direct correlation between earnings predictability and stock performance. The higher rated equities demonstrated not only superior gains in price, but also diminished risk as reflected in the percentage that produced a net loss for the period. As a whole, stocks with a lesser degree of predictability showed inferior performance and greater losses. The next two charts will illustrate these facts even further. Here we look at the predictability rank across the bottom, again, from a rank anywhere from 1 to 5 stars, and the annualized median gain. Now, notice over this period, again, they do refer to this as the lost decade because it just had abominable results of an average 2.7% annualized return for the S&P, and that does include dividends. Now, notice the very unpredictable companies were even lower than that, but the higher quality companies achieved higher and higher average annualized gains. This here reflects our risk of loss. And when we look at these stocks in groups, the percentage of stocks that lost money on the lower end of the predictability scale was extremely high, whereas the very highly predictable companies, very few in those baskets of stocks lost money over this time period. So far, this study has proven Buffett's belief that predictable companies make superior investments over the long term. Not only do they offer a much smaller chance of losing money, their upside potential is vastly superior as well. Now, next week we're going to cover the third and final part of the study. It will be a bit of a longer video, but we're going to examine the effects of paying reasonable prices, which is Buffett's third parameter, and putting all of his parameters to judge the final results.